The second biggest bank failure in American history is happening right now in our own backyard when the bank surprised investors saying it needed to raise more than $2 billion in capital to offset losses from bond sales. Well, that caused an all-out panic among the bank's clients who tried to withdraw $42 billion on Thursday alone, about a quarter of the bank's total deposits. The company's shares tanked 60%. Shares were halted altogether this morning, and now the feds have seized control of the lender. Silicon Valley Bank is among the top 20 commercial banks in the entire U.S. Its collapse is a huge deal. It's the biggest bank failure since Washington Mutual way back in 2008. I mean, it's hard to overstate what a big deal this is.
Now, startups had millions or even in some cases hundreds of millions of dollars deposited at Silicon Valley Bank, and now nobody's really sure just how much of that cash is left. This is money companies use to pay employees and run their startups.
The bank is imploding. Get out as soon as you can. This is extremely scary for those of us who, pay salaries and put food on the table for our employees.
During the pandemic, they generated a ton of cash that led to a surge in deposits.
The high interest rates that we've seen the Fed install across the economy has a negative effect. It makes the value of their investments worth less.
But it only insures deposits up to $250,000, and 97% of SVB accounts had more than the insured limit.
50% of the startups in this country are funded through SVP.
SVB is also the main bank for California wineries. That means there are thousands of wineries who don't know when they'll have access to their money, just like all of these other companies and individuals.
You just watched Silicon Valley Bank implode in one day. This is the second major U.S. bank facing liquidation in just a few days.
They're blaming FTX.
It's staggering what has happened to this bank and how quickly it has happened.
I know.
In anticipation, as the FTX situation was blowing up, that you could see the demise very, very quickly. I mean, it was just a year ago, maybe not even. Wall Street were really kind of looking at Silvergate as the next big hot thing, given the fact that the SEN was growing so rapidly.
So let's have a look at exactly what's causing these problems at SVB and Silvergate and discuss whether this is the Black Swan event that starts a new global financial crisis. At the end of December 2022, SVB employed 8,500 people with offices in 11 countries worldwide and had issued $74 billion worth of loans and held $212 billion worth of assets. So where did it all go wrong? One of the reasons SVB was so successful is that it's the go-to banking partner for early-stage businesses. The bank has a relationship with over 50% of all venture-backed companies in the United States. The vast majority of these companies are early-stage and pre-profit, so they receive investment in the form of equity from venture capital firms, which make them cash-rich. So these companies sit with cash in their bank accounts and then run that cash down over a period of time by paying staff, marketing, and investing into research and development of technology. Now, as a result of this dynamic, SVB's financial profile benefits from an abundance of client funds. Instinctively, you may be thinking that shouldn't be a problem. If the bank is sitting with lots of cash, then it should be in a very healthy situation. But actually, having too much cash can be a problem for banks because they need to make a return on that capital. So the problems at SVB actually started in 2021 when it saw a massive influx in deposits, which increased from around $62 billion at the end of 2019 to $189 billion at the end of 2021, which is a 3x increase in just 2 years. The traditional way that banks make money from deposits is by lending that money to other companies and charging them a higher interest rate. But Silicon Valley Bank had two problems with this. Firstly, the majority of its customers were not eligible for these loans because they were early-stage companies that were not making a profit. Secondly, the huge influx of cash deposits that it had meant that it was impossible to be able to lend out anywhere near that amount. So in order to try and make a return on the investment, Silicon Valley Bank turned to the capital markets, but unfortunately, the period that it received all this additional cash coincided with 2020. During 2020, interest rates were dropped to their lowest levels in history to keep the economy ticking over, so that meant that it became quite difficult to be able to earn any meaningful yield. So due to the fact that short-term interest rates were very low, Silicon Valley Bank looked to the longer-term markets, and the bank purchased over $80 billion of mortgage-backed securities. These bonds had an average yield of 1.56%, and the average term of these bonds was more than 10 years. The plan with this type of investment is to hold these assets until maturity. Now, over the course of the last 12 months, we've seen central banks start to increase interest rates. In the United States, interest rates have increased from 0.25 to 4.75%, a 19 times increase, which is just massive in such a short space of time. It's this movement that's caused a major problem for SVB because interest rates have an inverse relationship to the price of bonds. When a bond is issued, the interest rates on that bond is fixed to the current market conditions. So if we look at the portfolio that SVB invested in, as an example, for every $100 bond the bank is holding, it will only be paid $1.56 in interest every year. Whereas if you bought a bond in the market today, you'd get a yield of 4.75%. So your $100 bond would pay 4.75, 3 times as much as Silicon Valley's receiving on its bonds. So this is why there's a relationship between the interest rates and bond prices. That's the major problem for SVB because they've invested $80 billion of their customers' money into bonds that yield 1.56%. And the value of those bonds today is significantly lower than $80 billion. Now, over the long term, this wouldn't be a problem if SVB could wait until all these bonds matured. Then they would receive back the full $80 billion because you receive back your initial deposit when the bond expires. But Silicon Valley Bank can't afford to wait 10 years for those bonds to mature, and they have to sell them now into the market for a lower price than they bought them. And that's when you really start crystallizing major losses. And that's exactly what happened at Silicon Valley Bank. Because a large number of customers asked for their money to be returned, SVB was forced to sell the bonds that they're holding, meaning that they've incurred huge losses. The bankers announced that they've sold $21 billion of their securities at a loss of $1.8 billion, and as a result of this, the bank has announced that it needs to raise $2.25 billion in equity and debt. Now, this news came as a total surprise to investors who were under the impression that the bank had enough liquidity to avoid selling any of their securities. But the investors are now learning the portfolio is seriously underwater. Gary Tan, the president and CEO of Y Combinator, warned its network of startups before the implosion. Anytime you hear problems of solvency in any bank and it can be deemed credible, you should take it very seriously and prioritize the interest of your startup by not exposing yourself to more than $250,000 of exposure. Silvergate Bank was founded in 1988 as a traditional bank. However, in 2013, CEO Alan Lane invested in Bitcoin and started to launch an initiative to service cryptocurrency clients. The bank developed a strong niche, providing corporate services to all of the cryptocurrency businesses. Their flagship product was called the Silvergate Exchange Network, which allowed all of its cryptocurrency clients to exchange cryptocurrency for US dollars around the clock on a 24/7 basis. So essentially, Silvergate was acting as a real-world bridge between cryptocurrency clients and the markets. When companies like Coinbase sign up a new customer who gives them US dollars and wants to buy Bitcoin, Coinbase would then place those US dollars on deposit with Silvergate so that it had cash in reserve. And when the customers decided they wanted to cash out Bitcoin and take back their dollars, Coinbase would go back to Silvergate and ask for the dollars, passing those back to the customers. So Silvergate has been working with the big corporations in the world of crypto, offering deposits and also US dollar deposits. As the world of cryptocurrency got bigger and more exciting, it started to attract in more investment. Silvergate's value started to rise, and in 2019, Silvergate listed onto the New York Stock Exchange, selling its shares in an IPO that valued the business at around $230 million. As the crypto markets went up and the price of Bitcoin went through the roof, so did the share price of Silvergate, and at one point the shares were trading for $220 each, which valued the bank at around $4.2 billion. However, unfortunately, the events over the last 12 months had a detrimental impact on Silvergate's value. Silvergate's financial report for Q4 2022 revealed that the company made a net loss of $1 billion in the quarter, compared to a profit of $18 million in the previous quarter, and this loss was due directly to a bank run on the company's assets. In the 3 months ending December 2022, customers withdrew over $15 billion from Silvergate accounts, which represented over half of its total assets. Silvergate's deposits decreased by $6.9 billion or 52% to leave the bank with only $6.3 billion on deposit. The reason Silvergate posted such a colossal loss is that it had been putting all of its corporate deposits deposits into federal bonds. Rather than just holding on to the cash, Silvergate wanted to make a return on the capital. But the problem that Silvergate has encountered is that over the last 12 months, we've seen a huge increase in interest rates. And when the interest rates go up, the price of bonds go down. So what Silvergate has experienced over the last 12 months is all of the money that it's placed into the US government bonds has fallen in terms of the value. And because all these customers are now demanding their money back, Silvergate's been forced to sell bonds in the market to get that cash, and therefore they've crystallized huge losses. The details of this situation are included in their quarterly posting. In order to accommodate sustained lower deposit levels and to maintain a highly liquid balance sheet, Silvergate sold $5.2 billion of debt for cash during quarter 4 of 2022, and this sale resulted in a loss of $751 million in the quarter. In addition to that loss, the company also recorded a $134.5 million impairment charge related to an estimated $1.7 billion of securities that it expects to sell in the first quarter of 2023 to reduce its borrowings. As a direct result of financial difficulties, Silvergate decided to discontinue its Silvergate Exchange Network, which is the 24/7 payment system offered to all of its corporate customers. As a direct result of that announcement, a variety of cryptocurrency businesses, including Coinbase, have announced that they've dropped Silvergate as their banking partner. Silvergate has released the following statements announcing its intention to wind down operations and voluntarily liquidate the bank in an orderly manner. In light of recent industry and regulatory developments, Silvergate believes that an orderly wind down of bank operations and a voluntary liquidation of the bank is the best path forward. The bank's liquidation plan includes full repayments of all deposits. The company is also considering how best to resolve claims and preserve the residual value of its assets, including the proprietary technology and their tax assets. So this is obviously catastrophic news for investors in Silvergate Bank. At one point, this bank was valued at more than $4 billion, but it also represents seriously bad news for the crypto markets. Firstly, because all of the cryptocurrency businesses have now lost their banking relationship. These companies were previously using Silvergate to store all of their real-world dollars. But secondly, there's also the issues of contagion and confidence in financial markets, because all financial markets have interconnectivity. So when a company fails, it has a ripple effect to other businesses. So the failure of Silvergate will cause problems for other companies. But over and above that, in the world of crypto particularly, confidence is a key issue. And when investors see things like Silvergate Bank going into liquidation, that causes concerns. People start to become worried that crypto is imploding, which leads to further withdrawals. One of the reasons that Silvergate failed was because a lot of investors wanted to take their money out of crypto, so they were asking their exchanges to give them back their dollars. Those exchanges then asked Silvergate to return all of its dollars, and that forced Silvergate to sell all of the bonds, which were sitting at a loss, and therefore resulted in them losing over $1 billion in the last quarter of 2022. The failure of Silvergate is likely to accelerate more withdrawals, and so could cause problems for other crypto businesses over the course of the next 3 to 6 months. So what's the summary and conclusion today? The failure of one bank is big news, but the failure of two banks within a few days of each other, both based in the US, that's really big news. This could be potentially a warning sign that we have bigger problems in the wider financial sector. Now, both of these banks that we've talked about in today's video are specialty banks, so the overall dynamic of both of them is very similar. They've got large amounts of cash, and that was actually a problem for them because you got to do something with all that money. You have to make a return on all that money. And over the last couple of years, it's been very difficult to find investments that provide such a high yield because interest rates fell to the lowest levels in history, and therefore yields were very, very low. So in order to hunt down some form of yield, both of these banks sought out longer-term bond markets. But the problem that they've experienced is that now all of the customers have asked for their money back. So these two banks have actually become victims of their own success. They were so successful in attracting deposits that it meant they had too much cash for their own good. They actually couldn't find anywhere to invest that money. They stuck it into long-term investments, and they've now been caught out because their customers want their money back. And the only way that both of these banks can get the capital back is by cashing in all of their bonds, which are now trading at significant losses. This situation has resulted in the closure of Silvergate Bank, and it's now in liquidation, as well as SVB. So the looming question is whether other financial institutions around the world are in a very similar situation to these two banks. banks? And the answer to that is obviously yes. Banks and financial institutions are constantly looking for ways to make a return on their capital, and over the course of the last couple of years, it's been very difficult to find anything that provides a meaningful yield. So every single banking institution has been taking on lower yielding assets over the last couple of years, and we've seen this huge increase in interest rates that's now causing all kinds of problems. So it's extremely likely that banks and institutions are now sitting with large portfolios of investments that are completely out of the money. And if they're forced to cash in those portfolios, that means they'll have to crystallize losses in exactly the same way as Silvergate and SVB. So what's the likelihood of other banks and institutions also seeing a run on their assets? Well, the whole banking and financial sector is based on trust. You trust your bank to be able to look after your money and to give it back to you when you need it. If you wake up tomorrow morning and suddenly decide that you don't trust your bank and you want to take out all your money, you can do that. But if everybody wakes up with the exact same thought, then that would cause a run on the bank. And the problem with runs is that they're contagious. As soon as you hear the people are taking money out of your bank, you want to remove all of your own money as well, because you don't want to be the last guy when the bank runs out of cash sitting around wondering what happened. Now, all around the world, there are protection schemes in place, so most countries have rules and regulations whereby an element of your deposits will be protected, so it might be up to $250,000, for example. But if you're a corporation with 5 or 10 or 20 million on deposit at that same bank, $250,000 is just a drop in the ocean. And that's what's happened with Silvergate and SVB. They're mostly corporate banks, and those corporations have been concerned about the lack of liquidity. To a certain extent, that's exactly what happened with Bear Stearns and Lehman Brothers back in 2008 at the start of the global financial crisis. Back at that time, it was assumed that the problems encountered by those two banks were just specific to them and they wouldn't spread. However, the problems quickly spread throughout the entire sector, and we saw the biggest financial crisis for over 50 years unfold all around the world. As it stands at the moment, the problems being experienced by SVB and Silvergate look specific to those two banks. However, there is definitely a risk that this could be the start of something bigger. We could see contagion. We could see a domino effect. We could see a general loss of confidence in both banks and the crypto market, as all around the world, banking and financial sectors are correcting their evaluations of the risks involved. And if that does happen, then there is a real possibility that we could see more runs on more banks, more failures, and that could start a financial collapse all around the world.